Have you ever thought about living off the money that comes into your account every month? Without a boss, without clocking in, without depending on anyone? Sounds good, right? But then you hear, to live off dividends, you need at least $1 million. And then comes the butterflies in my stomach. Okay, that will never be for me. Maybe you've even thought about giving up before trying. After all, putting all this together seems like something out of a movie for rich people or for people who started investing in the 80s. But what if I told you that's not the whole truth? That there is a shorter path, yes, riskier, but entirely possible for you to achieve the freedom that so many people dream of. Today, I will show you the actual minimum value that you need to live off dividends. And the best part, you don't need 7 digits on the account. Stay with me, because the part that comes next could turn the switch on your head. You know, that advice that many people repeat without even thinking. Something like this: do you want to live off dividends only if you have between $1 and $3 million invested? Then you hear this and think, okay, so only in about 40 years, if everything goes well. But let me tell you something. This giant number they throw around, it's not a rule. It's just one version of the story. And most of the time it is the version told to those who live an expensive lifestyle and don't even think about alternatives. Now, imagine a more strategic person who knows where to invest, who accepts living simply, and who doesn't wait for the perfect scenario to start. This person, you don't need millions, you need a plan. And from the next topic, I will show you exactly how this plan works and why you may be much closer to freedom than you think. High profitability, lower investment. The less you need to live on per month, the less money you need to invest to achieve dividend freedom. Furthermore, choosing stocks or funds with higher dividends greatly reduces the amount needed to live off this income. That is, if you combine high-yield investments with a simpler lifestyle, you can achieve financial freedom with much less than most people imagine. In the next topics, I will show you real numbers with practical examples. When it comes to living off dividends, many people immediately think of the safest and most well-known companies, such as Johnson & Johnson, J&J. And no wonder. It is stable, has decades of consistent profits, and an impeccable history of dividend payments. But here's the truth that almost no one talks about. Security comes at a price, and it's high. Currently, J&J pays around 2.45% per year in dividends. This means the following. If you want to live on a monthly income of $4,000, which gives us $48,000 per year, you would have to invest about $960,000 only in J&J shares. In other words, almost $2 million invested to have a relatively basic income. Of course, this type of company has advantages. It's solid, hard to break, it has consistent growth, and it's the kind of action that many consider for life. But there is also a big negative point. Profitability is very low if your goal is to generate income now. This is why many people give up on living off dividends, because they look at this type of example and think that you can only live off this if you are a millionaire. The good news, there are assets that pay much more and require much less initial investment. Sure, they have more risk, but they could be the way for those who want to get out of the rat race well before traditional retirement. And that's what we're going to see now. Realty income. Monthly income. Less than $2 million, but still far from affordable. If Johnson & Johnson seems too safe and too slow to generate income, there is a slightly more generous alternative. Real estate investment trusts listed on the American Stock Exchange, known as REITs. One of the best known and most trusted is Realty Income, which trades under the symbol O. This fund is highly valued by those seeking income because it pays dividends monthly, unlike most stocks that pay quarterly. This creates a more constant cash flow, similar to receiving rent. Realty Income currently offers an approximate yield of 3.95% per year. To generate a monthly income of $4,000 or $48,000 per year, you would need to invest around $122 million in this asset. This represents a significant reduction from the nearly $2 million needed by Johnson & Johnson, which already makes the goal more achievable for those who are just starting to invest, but is still far from being accessible to most people. The advantages of realty income include a diversified portfolio of commercial properties, a consistent history of paying and increasing dividends over the years, and a predictable monthly income that can be a great help to those looking to gradually replace their salary. On the other hand, realty income still has limitations. Its yield, although better than that of companies like Johnson & Johnson, is still relatively low for those who want financial independence in a short period of time, such as 5 to 10 years. In addition, it is subject to real estate market risks, interest rate fluctuations, and possible economic crises. Therefore, realty income can be a good investment in a balanced portfolio, especially for those who value stability and predictability of monthly income. However, if the intention is to accelerate the process of financial independence, it may be necessary to consider investments with higher returns, even if this means taking on additional risks. In the next topic, we'll look at these higher-yielding options and how they can change your strategy. Altria, MO, high dividends, smaller investment, but more risk. After understanding how more conservative companies and real estate funds require high investments to generate significant income, it is worth knowing an example of a company that pays much higher dividends. Altria Group, a giant in the tobacco sector. Altria currently offers a dividend yield close to 7.27% per year, nearly triple that of Johnson & Johnson and nearly double that of realty income. This makes a huge difference in the amount of money you need to invest to live off dividends alone. Let's do the math to get a clear idea. To obtain a monthly income of $4,000 or $48,000 per year, with a yield of 7.27%, you would need to invest about $660,000. That amount is already much closer to what most people can save in a lifetime, and considerably less than the millions demanded by more secure companies. However, this higher yield comes with significant risks, which need to be considered carefully. Controversial and regulatory sector. The tobacco market is highly regulated, with constant risks of changes in laws and taxes that can affect the company's profitability and, consequently, the dividends paid to shareholders. Dividend volatility. While Altria has a solid track record, high-yield companies are generally more likely to cut or suspend dividends during times of crisis or poor financial performance. This can have a direct impact on your monthly income. Reputational and ethical risk. Investing in companies in sectors such as tobacco can raise ethical concerns for some investors, as well as reputational risks for those who prefer to invest in sectors considered more sustainable. Still, for investors willing to take on these risks and looking to accelerate their financial independence, companies like Altria can be a key part of their income generation strategy. This balance between return and risk is key to building a diversified portfolio that maximizes gains without exposing your assets to excessive risk. In the next topics, we will explore other forms of investment that offer even higher returns, such as funds that combine dividend strategies with options, always taking into account the impact of risk and consistency of impayments. Risk of relying on just one stock. Why diversification is key. When we talk about investing to live off dividends, a very common question is, can I simply choose a stock that pays high dividends and that's it? The answer is, no, that's too risky. A classic example that illustrates this risk is the case of AT&T, a company that for years was a benchmark for consistent and high dividends. Many investors relied on it for their monthly income, but suddenly, the company drastically cut its dividend payments, causing significant losses for those who depended exclusively on that income. This is because no company is immune to financial difficulties, market changes, or strategies that affect profits and dividend distribution. That's why diversification is essential for those who want to live off dividends safely. This means spreading your investment across different companies, sectors, and asset types so that if one of them runs into trouble, the others will continue to support your income. Additionally, diversifying can also help balance the risk and return of your portfolio, making your earnings more stable over time. Diversification isn't just about buying multiple stocks. It can also include real estate funds, ETFs, dividend funds, and even combined strategies which help protect your assets and ensure a more consistent income stream. Therefore, when putting together your portfolio to live off dividends, remember, never put all your eggs in one basket. In the next topics, we will show you fund and ETF options that combine high dividends with smart strategies for diversification and protection. Covered call ETFs, high yields with monthly payouts. If you want to generate higher and more frequent dividend income, ETFs that use the dividend yield strategy covered call are a very interesting option. But what exactly is this? Basically, a covered call ETF invests in stocks, like any fund, but it also sells call options on those stocks. These options are contracts that grant the buyer the right to buy the stocks at a fixed price within a specific time frame. In exchange for this sale, the fund receives a premium, a kind of extra rent that increases the income distributed to shareholders. This strategy allows the ETF to generate extra income, which is then passed on to investors as monthly dividends. As a result, these ETFs tend to have much higher returns than traditional stocks. Some famous examples of these ETFs are QYLD, Global X Nasdaq, 100 Covered Call ETF, yield around 11.8% per year. Often, JP Morgan Equity Premium Income ETF, yield in the range of 7% to 9% per year. NUSI Nationwide Risk Managed Income ETF typically yields between 6% and 8%, with an extra layer of downside protection. With these ETFs, the amount needed to generate an income of $4,000 per month drops dramatically. For example, in the case of QYLD, with an annual yield of around 11.8%, you would need approximately $490,000 invested to achieve this income. That's less than half of what would be needed with traditional investments like Johnson & Johnson, and nearly a third of what would be needed with realty income. However, it is important to highlight that this greater profitability comes with different risks. Share prices in the ETF may be more volatile. The covered call strategy can limit the gains in the asset's growth. Taxation on these funds may be less efficient depending on your tax situation. Still, for those seeking faster financial independence and who are willing to understand and accept these risks, covered call ETFs are a powerful tool. In the next topic, we will talk about how reinvesting dividends can help reduce the initial amount needed to live solely on passive income. Reinvesting dividends, the key to growth and financial freedom. Reinvesting dividends means using the money you receive as payment to buy more stocks or shares rather than spending it immediately. This is one of the most powerful secrets to accelerating your financial independence. When you reinvest, your money grows not only by the value of the shares you already own, but also by the new shares purchased with the dividends. This creates an effect called compound interest. That is, gains begin to generate even more gains. Imagine you receive $100 in dividends and use that money to buy more shares. In your next payment, you receive dividends not only from the original shares, but also from the new shares you bought with that $100. Over time, this makes a huge difference in the total amount you invest and the amount of monthly income you generate. This reinvestment cycle is what turns a small amount into a significant passive income over the years. Therefore, even those who are unable to invest a large amount at the beginning can, with patience and discipline, achieve financial freedom. Additionally, reinvesting dividends helps offset potential declines in the stock price and can increase your risk protection. However, when you start to rely on dividends to pay your expenses, reinvestment slows down or stops because you will use this income to live. Therefore, the initial accumulation and reinvestment phase is essential. In short, reinvesting dividends is the most efficient way to reduce the initial capital needed to live off passive income and achieve financial independence faster. In the next topics, we will explore how to combine these strategies to build an ideal portfolio. Covered. Call ETFs, risks and taxes, what you need to know. ETFs that use the strategy of covered collar, great for those who want high returns and monthly payments, but they also have some disadvantages that are important to know before investing. Specific risks, limitation of upside potential. By selling call options, the fund gives up part of the stock's appreciation if the price rises significantly. This means that during periods of strong market growth, the ETF's gains may be limited, even if the underlying stocks are appreciating significantly. Volatility and market risk. Although the strategy seeks to generate consistent income, the price of ETF shares is still subject to fluctuations in the stock market, which can lead to capital losses. Strategy risk. If the market falls sharply, the option premiums may not compensate for the decline in the value of the stock, and the investor may suffer losses. Tax issues. Taxation of dividends and bonuses. The income from these ETFs may be taxed differently than traditional dividends. Depending on the jurisdiction and the type of account where the investment is held, this may result in a higher tax burden. Tax complexity. Investors need to be aware of local rules and may need expert help to understand the tax impact, especially if ETFs make frequent distributions. While covered call ETFs are powerful tools for those looking to increase passive income, it is essential to understand that they are not risk-free and that tax efficiency may vary. Therefore, it is essential to study the product carefully and analyze whether it fits your profile and financial goals before investing. In the next topics, we will see how to use these and other strategies to build a diversified and balanced portfolio that combines security, income, and growth. The importance of starting early and maintaining consistency. One of the most important secrets for those who want to live off dividends is start as soon as possible and be consistent in investments. Why? Because time is the greatest ally of the investor who reinvests his dividends. The sooner you start, the more time you will have for the effect of compound interest to take effect, making your wealth grow exponentially over the years. Furthermore, maintaining discipline and investing regularly, even with small amounts, helps you take advantage of market downturns to buy cheaper and maximize your gains in the long term. Even if you can't invest a large amount right away, the important thing is to create the habit of investing monthly and not give up in the face of natural market fluctuations. Consistency turns small contributions into large sums, and reinvesting dividends speeds up this process. Another important point is to remain patient and avoid making hasty decisions based on emotions or market volatility. Finally, it is essential to review your portfolio periodically to adjust the portfolio according to your objectives, risk profile, and changes in the market. In short, it doesn't matter if you can only start with a small amount. What matters is starting early and being consistent, as this will make all the difference in you achieving financial independence and living off dividends. Conclusion. The journey to living off dividends starts now, a path made of strategy, discipline, and courage. If you've made it this far, you already know that the idea that you need millions to live off dividends isn't an absolute rule. In fact, the minimum amount you need depends on the choices you make, the assets you select, how much you reinvest, your risk tolerance, and the discipline you maintain over time. In this video, we show that even with less money than most people imagine, it is possible to start generating a significant passive income. Traditional companies pay stable dividends, but require high investments to achieve a comfortable income. Real estate funds and some ETFs offer more attractive returns, but they also come with their own risks and challenges. Additionally, we've seen that investing in stocks with very high dividends can speed your path forward, but it's crucial to understand the risks involved, such as unexpected dividend cuts and market swings. Diversification has proven to be a fundamental element in protecting your assets and ensuring income stability. Don't put all your money into a single stock or sector, as this can expose you to unpleasant surprises that directly impact your monthly income. We also talked about covered call ETFs, which combine smart strategies to increase yield and provide monthly payments, although with a little more complexity and specific risks. This can be a very interesting option for those who want to speed up the process, as long as they are prepared to understand how these funds work. But perhaps the most powerful point of this content is the understanding that time is your greatest ally. Starting early, even with modest amounts, and being consistent in your contributions, using the reinvestment of dividends, creates a multiplier effect called compound interest, which can transform small investments into a solid and growing source of income. No financial journey is made overnight. It requires patience, discipline, and a long-term focus. You can even start by investing a little, but the important thing is not to put it off, not to wait for perfect conditions or that magic amount to take the first step. Every dollar invested today is a brick in the construction of your financial freedom. Tomorrow, every reinvestment, every regular contribution, every study and conscious decision brings you closer to the goal of living off passive income. So the final message is clear. Financial independence through dividends is within reach of those who decide to start, plan, and persist. Now that you know the paths, the options, the risks, and the strategies, the choice is in your hands. The time to act is now. Whatever your starting point, the important thing is to take the first step and stay focused. The road may be long, but the destination, living with financial freedom, is worth every effort. I'm here to help you on this journey. Together, let's transform your relationship with money and build a future where dividends work for you.